The macroeconomic background before the decision. When analyzing the Federal Reserve's decision in September 2025, it is impossible to separate it from the broader macroeconomic backdrop, which has been shifting rapidly on a global scale. Every Fed move reflects a convergence of pressures: domestic inflation, economic growth, labor market dynamics, and international financial stability. These foundations form the background picture that helps us understand why the Fed opted to cut rates after a prolonged tightening cycle, and why the so-called sharks, or large institutional players, are watching this moment closely to deploy their strategies. First and foremost, the critical factor is inflation. After the inflation crisis of 2022 to 2023, when consumer prices surged above 8%, the Fed executed the most aggressive rate hiking cycle since the early 1980s. The federal funds rate was pushed above 5%, triggering a liquidity shock and reshaping the entire global financial environment. By 2025, however, the trajectory had shifted. Tight monetary policy, the gradual normalization of supply chains after the pandemic, and declining energy prices combined to bring U.S. inflation down significantly, moving closer to the Fed's 2% target. At the same time, the U.S. labor market began to show signs of cooling. The unemployment rate, which had hovered at historic lows for years, started to tick higher. Monthly jobs reports revealed slower hiring and softer wage growth, easing the cost-push pressure on businesses. This development carries two opposing implications. On the one hand, it gives the Fed more confidence in loosening policy since the risk of a wage price spiral has diminished. On the other hand, it raises concerns that the U.S. economy may be entering a slower growth phase as domestic demand loses some of its earlier momentum. GDP growth in the first half of 2025 highlighted this divergence. The first quarter remained solid, supported by household spending and services, but in the second quarter, growth slowed noticeably. Business investment declined, particularly in manufacturing and commercial real estate. After an extended period of elevated rates, the cost of capital became a heavy drag on corporate balance sheets. This was one of the primary reasons the Fed had to consider easing rates to prevent the risk of a hard landing. Another factor is public debt and the Treasury market. After years of aggressive fiscal spending, federal debt has surpassed GDP, and the government has been issuing massive amounts of treasuries. Elevated rates compounded the burden, driving interest expenses higher and straining long-term fiscal sustainability. The Fed, while mindful of its inflation-fighting credibility, cannot ignore these financial stability risks. Cutting rates, therefore, is not only about supporting growth, but also indirectly easing fiscal pressure. The global backdrop further complicates the decision. Europe's economy has stagnated. China continues to wrestle with its property sector crisis and domestic imbalances, and emerging markets are saddled with heavy foreign currency debt. In this context, the U.S. remains the gravitational center of global capital flows. Every Fed action reverberates instantly across borders. When the Fed keeps rates high, the dollar strengthens, drawing capital into the U.S. but suffocating emerging economies dependent on cheap external financing. Conversely, when the Fed eases, the dollar tends to weaken, redirecting capital into risk assets ranging from U.S. equities to commodities and even cryptocurrencies. Equally important is the market's expectation before the decision. Throughout the summer of 2025, investor sentiment swung wildly with each economic data release. Fed funds futures steadily priced in a higher probability of a September rate cut, from less than 30% in early Q2 to over 70% by August. This indicates that the market was already positioned for such a move. But, as always, the true impact hinges not only on the action itself, but also on the communication from Fed Chair Jerome Powell. A cut framed as one and done would be read as a cautious adjustment. But if Powell signals the beginning of a new easing cycle, the psychological and capital flow impact could be dramatically larger. Taken together, the macroeconomic picture ahead of the September FOMC meeting is a mix of contrasting forces. On one side, inflation has cooled enough to give the Fed room to maneuver. On the other, growth is slowing, the labor market is softening, and fiscal strain is intensifying. Globally, the U.S. still anchors capital flows, but also bears responsibility for maintaining systemic stability. This blend of conditions makes the rate cut a pivotal decision. It is not merely a technical adjustment to borrowing costs. It is a strategic signal to the world that the Fed perceives recession risks as greater than inflation risks, that it is willing to pivot policy to safeguard growth, and that the U.S. financial system remains resilient enough to operate in a lower rate environment. Naturally, when the most powerful central bank in the world moves in this direction, large institutions, the true sharks of the market, will not miss the chance to act. Yet before exploring their tactics, it is essential to recognize that every strategy rests on the macro foundations just outlined. Without the cooling inflation, without the weakening data, and without the buildup of expectations, the Fed would not have been in a position to cut. And without the cut, the sharks' carefully prepared playbooks could not be executed. In summary, the macroeconomic backdrop ahead of the September 16th and 17th decision can be distilled into three key points. First, inflation has declined enough to create policy space. Second, growth and the labor market are weakening, pushing the Fed toward a pivot to avoid recession. Third, market expectations have been primed, making a cut both economically and psychologically sound. These three forces combined set the stage for the decision itself and for the sophisticated maneuvers of the major financial players who move immediately once the news is released. The meaning of the Fed's rate cut. When the Federal Reserve makes the decision to cut interest rates, the act itself is straightforward. The target range for the federal funds rate moves lower. But in the world of finance, this seemingly simple adjustment carries far deeper implications than a mere change in the cost of short-term borrowing. For investors, policymakers, and institutional giants alike, the decision is a layered signal, shaping the trajectory of capital flows, altering relative valuations across asset classes, and redefining how risk is priced in the global financial system. To understand the meaning of this particular September 2025 cut, one must first appreciate the duality of what a rate cut represents. It is simultaneously an acknowledgement of current weakness and a promise of future support. The Fed, by easing policy, admits that the prevailing path of growth has slowed, that the risks of stagnation or even recession have grown too large to ignore. But it also communicates that monetary authorities stand ready to cushion the economy, to stabilize credit markets, and to sustain liquidity. This combination, recognition of fragility coupled with reassurance of resilience, is the essence of why rate cuts are so consequential. The first and most direct meaning of a cut lies in its impact on the U.S. dollar and bond yields. The federal funds rate is the anchor for the entire curve of interest rates. Once the Fed lowers that anchor, yields across the maturity spectrum tend to drift lower as well, though not uniformly. Short-term Treasury yields respond quickly, while longer-dated bonds reflect the market's expectations for future inflation and growth. In this case, the cut signals that the Fed prioritizes supporting growth over combating inflation, which nudges real yields lower. As a result, the dollar often weakens relative to other major currencies, altering the balance of global capital flows. For exporters, this can be a relief. For global investors, it creates a ripple that affects everything from commodity prices to emerging market debt. The second layer of meaning lies in credit conditions and corporate finance. A lower benchmark rate reduces the cost of borrowing for banks, corporations, and households. For businesses that had been delaying expansion or shelving investment plans under the burden of high financing costs, the cut breathes new life into projects. For highly leveraged firms, particularly in real estate or capital-intensive industries, it is a lifeline. In this sense, the Fed is not just cutting rates, it is buying time for the private sector to adjust, refinance, and reposition. This prolongs solvency for many, but it also risks sustaining unproductive companies, an issue that can linger if easy money persists too long. Third, there is the signal to equity markets. Historically, equities often rally on rate cuts, not simply because future cash flows are discounted at lower rates, but because investors interpret the cut as a vote of confidence in the Fed's willingness to act preemptively. Risk premiums shrink as investors feel protected by monetary policy, and capital flows toward growth-sensitive sectors such as technology, consumer discretionary, and financials. However, the context matters. A cut delivered during an outright crisis can spark fear rather than relief, suggesting conditions are worse than publicly acknowledged. In contrast, a cut delivered in a cooling but still functional economy, as is the case in 2025, tends to reinforce optimism, at least in the short term. The fourth dimension of meaning is the message about inflation. By cutting, the Fed implicitly declares that inflation is no longer the primary threat. For 2 years, policymakers insisted that their credibility depended on restoring price stability, keeping rates high even at the cost of slower growth. The pivot away from that posture communicates that inflation has been subdued sufficiently to allow flexibility. For households and firms, this is a powerful narrative shift. The era of punishing borrowing costs is easing, replaced by an environment more conducive to consumption and investment. Yet this pivot is also a gamble. For if inflationary pressures reemerge through wages, energy shocks, or geopolitical instability, the Fed's credibility could once again be tested. Beyond the economic mechanics, the rate cut carries a strategic geopolitical meaning. The US dollar is the world's reserve currency, and Treasury securities are the foundation of global finance. By reducing rates, the Fed affects the calculus of foreign governments, sovereign wealth funds, and multinational corporations managing trillions of dollars in reserves. A weaker dollar relieves pressure on emerging markets with dollar-denominated debt, but it also encourages global diversification away from US assets. This can alter diplomatic and trade dynamics subtly yet powerfully. The September 2025 cut, therefore, is not just about domestic stabilization. It is a recalibration of the US's role in the global monetary system. Equally critical is the psychological dimension. Markets are not governed solely by data, but by interpretation. A cut shifts investor psychology from defensive to opportunistic. Retail traders may view it as a green light to chase riskier assets, while institutional players interpret it as confirmation of the policy cycle turning. In both cases, sentiment changes. This shift in psychology often triggers flows that outweigh fundamentals in the short term. The sharks of Wall Street understand this better than anyone, which is why they prepare months in advance for the precise moment of the announcement. Knowing the weight of sentiment can move prices more violently than the actual mechanical effect of a 25 or 50 basis point reduction. Another layer of meaning comes from the Fed's forward guidance. The cut itself is the headline, but the language surrounding it is the substance. If Chair Powell emphasizes caution, framing the cut as an insurance policy rather than a new trend, the market may rally briefly but remain restrained. If instead he signals that the September move marks the beginning of an easing cycle, then risk assets could surge, the yield curve steepen, and global liquidity expand rapidly. The nuance of guidance, therefore, magnifies or tempers the meaning of the cut. Finally, the Fed's decision must be understood in the context of financial stability and systemic risk. Years of elevated rates tested the resilience of banks, particularly regional lenders with long-duration assets. The cut offers immediate relief, easing mark-to-market losses on bond portfolios and stabilizing funding costs. For regulators, this is a way to preempt fragility in the banking system from escalating into crisis. The meaning, then, extends beyond monetary policy into the realm of safeguarding the plumbing of finance itself. When synthesizing all these layers, the September 2025 cut emerges as far more than a simple technical move. It is an admission that growth risks now outweigh inflation risks, a recalibration of credit conditions for businesses and households, a signal to equity markets that the Fed stands behind growth-sensitive assets, a psychological turning point in investor sentiment, a geopolitical adjustment in the role of the dollar and U.S. assets, a safeguard for systemic financial stability. This is why every rate cut reverberates so strongly. It is not the 25 basis points that matter, but the narrative, the expectations, and the cascade of decisions it sets into motion across portfolios worth trillions. For the sharks, this is precisely the environment they seek, an intersection of technical change and psychological shift, where liquidity is plentiful and retail sentiment can be harnessed to amplify moves. In conclusion, the meaning of the Fed's September rate cut lies not in the mechanical details, but in the message it sends. It tells the world that the U.S. economy has entered a new phase, where growth protection has eclipsed inflation vigilance, where credit will be easier, and where risk assets can breathe again. But it also tells us that fragility remains, and that the central bank is steering carefully to balance optimism with caution. For professionals, recognizing this layered meaning is the key to anticipating not just the immediate market reaction, but the strategic positioning of institutions in the months ahead. How the sharks move after the decision. When the Federal Reserve delivers a rate cut, the immediate headlines focus on the size of the reduction and the press conference that follows. But beneath the surface, the true battle begins. For institutional players, the so-called sharks, the rate cut is not a surprise. They have anticipated it, positioned for it, and often nudged market psychology toward it. What matters most is how they execute their strategies in the hours, days, and weeks after the decision, using volatility, sentiment, and liquidity to maximize their advantage. The first behavior of sharks is pre-positioning. Long before the September meeting, large institutions had already adjusted portfolios in anticipation of the pivot. They accumulated assets likely to benefit from a weaker dollar and easier financial conditions, growth equities, high-yield credit, commodities such as gold, and even risk-on assets like cryptocurrencies. Simultaneously, they lightened exposure to sectors vulnerable to falling yields, such as defensive stocks or safe haven currencies. When the cut is officially announced, these positions are already in place, ensuring that the sharks are not reacting to the news but capitalizing on the reaction of others. The second move comes in the form of liquidity traps and false breakouts. Sharks understand that retail traders and smaller funds will rush to chase the initial spike in prices. In the first few minutes after the announcement, equities may surge, the dollar may tumble, and gold may spike higher. But sharks often use these moves to create liquidity. By pushing prices beyond obvious technical levels, they trigger stop losses and breakout orders from smaller players. This allows sharks to offload positions into strength or accumulate at better levels once the retail wave subsides. The violent reversals often seen in the immediate aftermath of Fed decisions are not random. They are manufactured opportunities for redistribution. The third behavior is cross-asset rotation. Sharks do not think in terms of single markets. They think in terms of flows. A weaker dollar means stronger commodities, which means opportunities in emerging markets, which then feed back into global equity risk appetite. By rotating capital swiftly across currencies, bonds, equities, and alternatives, they exploit the interconnectedness of the system. For example, a hedge fund may short the dollar against commodity currencies, while simultaneously going long on gold miners and buying call options on tech stocks. Each leg of the trade is part of a coordinated strategy designed to capture both the direct and second-order effects of the Fed's pivot. Fourth, sharks engage in volatility harvesting. The period after a rate cut is marked by wide swings in prices as markets digest the implications. For retail traders, this is noise. For sharks, it is raw material. By selling options at elevated implied volatility and delta hedging the positions, they extract premium from jittery investors. Alternatively, they may buy volatility ahead of the announcement and unwind it once realized volatility spikes, locking in gains. In either case, the cut provides a catalyst for volatility regimes to shift, and sharks are structurally positioned to monetize that shift. Another dimension is narrative control. Sharks are not just traders, they are influencers. Through research notes, media appearances, and even coordinated flows, they shape the story that retail traders and smaller institutions consume. If the prevailing narrative is, the Fed is pivoting to support growth, then sharks may amplify that optimism, driving retail money into equities. If instead they want to fade the rally, they may circulate warnings about inflation returning or about the Fed being behind the curve. The key is that they move not just capital, but perception, because perception moves capital in turn. One of the most powerful tactics sharks use is timeframe divergence. Retail traders tend to focus on intraday moves, while institutional players think in terms of months or quarters. A shark may happily allow a stock index to rally for several sessions, knowing that the broader macro adjustment will play out over weeks. During this period, they patiently accumulate or distribute positions. By the time the average trader realizes the initial rally has stalled, sharks have already rotated capital into the next opportunity. The September 2025 cut will likely be no different. Short-term euphoria, followed by medium-term repositioning that only becomes clear in hindsight. There is also the matter of risk transfer. Sharks excel at transferring risk from their balance sheets to the hands of less sophisticated investors. A Fed rate cut provides the perfect backdrop. As bond yields fall, demand for corporate debt may surge, allowing institutions to unload lower quality paper at attractive prices. Equity rallies enable them to distribute shares in companies with weaker fundamentals under the cover of bullish sentiment. By the time the cycle turns again, much of the risk has already been passed downstream. Importantly, sharks do not move in unison. Different institutions have different mandates. Sovereign wealth funds may increase allocations to equities for diversification. Hedge funds may trade aggressively across asset classes. Banks may focus on credit portfolios. But collectively, their actions create the tidal forces that drive prices. Retail participants often imagine a single invisible hand, but in reality, it is the aggregation of multiple sophisticated strategies, all converging on the opportunities created by the Fed's shift. One of the most underappreciated behaviors is option market engineering. Sharks use derivatives not only to hedge, but to steer spot markets. By loading up on call options in equities or commodities before the Fed cut, they create dealer hedging flows that mechanically push prices higher once the news breaks. Similarly, heavy put positioning in the dollar can accelerate its decline as dealers unwind hedges. These dynamics are invisible to the casual observer, yet they are central to how sharks magnify the impact of Fed decisions. Longer term, the sharks will evaluate whether the cut marks the beginning of a cycle or a one-off adjustment. If Powell signals that multiple cuts are likely ahead, institutions will reposition portfolios structurally, increasing duration in bonds, expanding leverage in equities, and raising allocations to real assets. If instead the cut is framed as limited, sharks may treat the rally as tactical rather than strategic, fading excessive optimism and preparing for renewed volatility. The divergence between these scenarios creates opportunity for those with the scale and patience to play both sides. At the heart of shark behavior is discipline. Unlike retail traders, sharks are not seduced by headlines. They view the Fed's decision as one data point within a broader strategy. They size positions according to risk limits, hedge exposures across multiple instruments, and maintain flexibility to adapt as new information arrives. Their advantage lies not only in capital, but in process, the ability to execute with precision when others are driven by emotion. For the September 2025 decision, the likely sequence of shark behavior can be distilled as follows. Immediate phase, minutes to hours. Use volatility spikes to trigger stops, generate liquidity, and capture retail flows. Short-term phase, days. Rotate across asset classes, amplify narratives, and monetize option market dislocations. Medium-term phase, weeks. Accumulate or distribute positions patiently, aligning with the expected trajectory of policy. Long-term phase, months. Rebuild structural portfolios based on whether the cut evolves into a cycle. Each phase is interconnected, with the short-term maneuvers serving the long-term positioning. Sharks know that markets are ecosystems of emotion layered on fundamentals, and they exploit both with equal precision. In the end, the meaning of shark behavior after a Fed cut is this: they are not reacting to the decision, they are orchestrating around it. The retail trader sees a headline, the shark sees a chessboard. The average investor reacts to prices, the shark engineers prices. And while the Fed may set the stage, it is the sharks who write the play in real time, the strategic battlefield of sharks. After the Fed's cut, when the Federal Reserve officially cut rates on September 16th and 17th, 2025, the stage was set for a financial battlefield unlike any other. The decision itself was not the endgame. It was merely the starting pistol for the sharks of the market, those heavyweight institutions and funds that shape liquidity flows and steer asset prices with their massive capital. To understand their behavior in the aftermath, one must analyze not only the direct market reactions, but also the deeper strategic calculations that unfold in the hours, days, and weeks that follow. The first rule of shark behavior is that they do not chase headlines blindly. By the time the Fed makes an announcement, most large players have already positioned themselves for multiple scenarios. Their goal is not simply to guess correctly, but to exploit volatility, not the missteps of smaller traders and the predictable overreactions of retail crowds. In this sense, the Fed cut provides less of a surprise and more of a structural opportunity, an inflection point around which capital can be aggressively reallocated. Equities, the initial thrust. The S&P 500, Nasdaq, and Dow typically see knee-jerk rallies immediately after a rate cut. Retail investors interpret lower rates as bullish fuel for stock prices, and algorithms pick up on momentum. Sharks, however, use this burst of liquidity to unload positions accumulated earlier. In other words, while the public chases the green screens, institutions often sell into strength, locking in profits. This behavior is grounded in a long-standing pattern. The first rally after a policy pivot is rarely sustainable unless accompanied by clear forward guidance of an easing cycle. If Powell's language is cautious, sharks know the upside is limited and act accordingly. Bonds and yields, the real battlefield. Unlike equities, the bond market is where the Fed's decision bites deepest. Yields across the curve shift instantly, and this is where sharks deploy their heaviest firepower. A cut at this stage signals that the Fed sees slowing growth, so long-dated Treasury yields often compress, triggering a rally in government bonds. Large funds engage in duration trades, betting on further declines in yields. At the same time, sharks carefully structure curve steepeners or flatteners depending on Powell's guidance. Retail eyes may be on the stock market, but in truth, the decisive money is made in bonds. The dollar and global flows. The dollar index, DXY, is the thermometer of global capital reaction. A Fed cut typically weakens the dollar, which in turn sparks flows into commodities, emerging markets, and risk assets. Sharks exploit this through currency carry trades, borrowing cheaply in dollars and reallocating into higher-yielding assets abroad. They understand that the Fed's pivot reshapes the global financial map, not just the domestic one. Smaller players may see only ERUSD or GBPUSD charts ticking higher, but institutional capital is rebalancing entire multi-billion-dollar portfolios on the back of these shifts. Commodities and gold. Lower rates weaken the dollar and reduce the opportunity cost of holding non-yielding assets like gold. Sharks know that gold responds not only to inflation, but also to real rates, which are now declining. Accumulation in gold and even energy-related commodities often begins before the announcement and accelerates after, with sharks using the post-Fed volatility to disguise their moves. When smaller traders pile into gold after headlines, the institutions are often already in position. Crypto as a satellite play. Although still a fringe asset compared to traditional markets, cryptocurrencies have become an outlet for liquidity seeking higher risk-adjusted returns. Sharks recognize that a Fed cut lowers funding stress, revives speculative appetite, and draws flows into Bitcoin and major altcoins. The difference is that while retail traders chase parabolic moves, institutions increasingly manage exposure through derivatives, using futures and options to both hedge and amplify moves. In this sense, sharks dominate even the supposed decentralized frontier of finance. One must also note the psychological layer of the battlefield. Sharks thrive on exploiting human bias. They know that retail investors equate rate cuts with bull markets. They also know that the initial hours after the Fed decision are characterized by confusion, headline chasing, and extreme positioning. By deliberately creating whipsaw moves, buying heavily into one direction and then abruptly reversing, sharks force smaller traders to capitulate. The volatility is not random, it is engineered. Every sharp move, every sudden reversal is a tactic in redistributing wealth from the many to the few. Strategically, sharks break down their playbook into time horizons. In the short term, they exploit volatility. In the medium term, they build structural positions aligned with macro themes: weaker dollar, lower yields, rising gold. In the long term, they seek to ride the policy cycle, anticipating not just one cut, but the trajectory of Fed easing over quarters to come. This layered approach ensures that while retail players burn out in the noise of hourly charts, institutions are quietly planting seeds for profits that may not be harvested for months. An essential point is that sharks never view the Fed decision in isolation. They know that monetary policy is a dialogue, not a one-off move. After the cut, they study every Fed speech, every data release, and every market reaction for signs of confirmation. They also pressure test the Fed itself, pushing markets to extremes to see how officials respond. If Powell suggests the cut is insurance, sharks test the limits of that insurance by driving yields lower or equity valuations higher, gauging where the Fed will step in with verbal intervention. Finally, sharks operate with the understanding that liquidity equals power. The rate cut opens new channels of liquidity. Credit markets ease, funding costs decline, and leverage becomes more attractive. For large players, this is the fuel they need to expand positions. Hedge funds, private equity, and sovereign wealth funds will all move aggressively in this environment, absorbing assets that weaker hands are forced to sell. The battlefield may look chaotic, but beneath the noise lies a structured redistribution of liquidity from the Fed's decision into the hands of those most skilled at wielding it. In conclusion, the sharks' actions after the September rate cut can be summarized in one phrase: orchestrated opportunism. They prepare in advance, strike during volatility, and build for the longer cycle. Stocks may grab headlines, but the real war is fought in bonds, currencies, and global flows. For the Fed, the cut was a policy adjustment. For the sharks, it was the opening of hunting season. And as history has shown time and again, in the waters of global finance, it is always the sharks that eat first. The psychology and behavior of retail investors. In every major monetary event, such as the Federal Reserve's decision to cut rates on September 16th and 17th, 2025, the spotlight often falls on institutions, hedge funds, and the so-called sharks of the market. Yet, beneath this surface lies an equally important story: the psychology and behavior of retail investors. These millions of small participants, though individually insignificant, collectively form a powerful force that can amplify trends, create bubbles, and fuel volatility. Understanding their mindset is crucial to grasping how markets truly react after a policy shift. Retail investors are driven not by complex algorithms or deep macroeconomic models, but by emotion, perception, and simplified narratives. When the Fed cuts rates, the immediate retail response is often to interpret it as unambiguously bullish. Lower borrowing costs equal easier money, and easier money equals rising asset prices. This mental shortcut, while not entirely wrong, oversimplifies the situation. Sharks exploit this very bias, knowing that retail investors will rush into risk assets, often at the worst possible timing. The fear of missing out, FOMO, plays a central role. As headlines flash across screens and social media amplifies the news, retail traders feel compelled to act instantly. They see green candles on equity charts, hear pundits declaring a new bull cycle, and convince themselves that hesitation equals lost opportunity. The psychological pain of missing gains often outweighs the fear of potential losses, pushing them into impulsive buying. This herd behavior creates the initial surge of liquidity that institutions use to offload or reposition. At the same time, overconfidence bias becomes pronounced. Retail traders frequently believe that they can outsmart the market with quick decisions, especially during periods of heightened news flow. Armed with trading apps and real-time data, they mistake access for expertise. In the days following the rate cut, message boards and online forums flood with hot takes and strategies, reinforcing a collective illusion of control. Yet, behind the scenes, the true price drivers remain the massive orders of institutional players, not the scattered trades of individuals. Another psychological trap is the anchoring effect. Retail investors anchor their expectations to past cycles, assuming that a rate cut will trigger the same prolonged bull market that followed in 2009 or 2020. They project old outcomes onto new contexts without accounting for differences in inflation dynamics, fiscal conditions, or global imbalances. This mental shortcut blinds them to the possibility that the Fed is cutting rates not because the economy is healthy, but because risks of slowdown or recession are growing. Short-termism also defines retail behavior. Unlike institutions that can build positions over quarters, retail traders tend to focus on immediate moves, minutes, hours, or at most a few days after the announcement. This myopic horizon leads them to overreact to intraday volatility. A sharp dip after the initial rally can trigger panic selling, only for them to chase the rebound minutes later. The cycle of buying tops and selling bottoms is not merely bad luck. It is a predictable consequence of emotional decision-making in an environment engineered by sharks. Social dynamics amplify these psychological weaknesses. Online communities, while offering camaraderie, often function as echo chambers. A few influential voices proclaim a new bull run, and suddenly thousands of smaller traders act in unison, reinforcing the narrative. The herd instinct becomes self-fulfilling for a time, driving prices beyond rational valuations. Yet when reality intrudes, whether through disappointing earnings, a contradictory Fed speech, or a sudden reversal in bonds, the same herd turns fearful, accelerating the downside as they rush to exit simultaneously. Retail investors are also particularly vulnerable to loss aversion. Studies consistently show that the pain of losing $1 is psychologically stronger than the pleasure of gaining $1. After the initial euphoria of the Fed cut, when volatility inevitably strikes, many retail traders panic at small drawdowns. Stop losses are triggered at poor levels, or worse, positions are closed emotionally without discipline. Meanwhile, institutions patiently wait for this wave of capitulation to finish before re-entering at more favorable prices. Yet, it would be a mistake to dismiss retail behavior as irrelevant. Their actions create liquidity pockets that institutions rely upon. Every FOMO-driven surge provides exit liquidity for sharks, and every panic-driven sell-off creates entry points. In essence, retail psychology is the raw material from which professional traders manufacture profits. Without the collective overreactions of millions of individuals, market moves would be far less dramatic, and opportunities for large-scale players would shrink. The broader consequence of retail behavior is the feedback loop it creates with monetary policy communication. The Fed knows that its words and actions influence not just institutions, but also households and small investors. A rate cut intended as insurance can quickly be misinterpreted by retail crowds as the start of a bull market, inflating valuations and complicating the Fed's task of managing financial stability. This is why Powell's tone, body language, and forward guidance are as carefully analyzed as the rate decision itself. The Fed does not want to trigger irrational exuberance, yet retail psychology makes that risk ever present. In conclusion, the psychology and behavior of retail investors after the September 2025 rate cut can be summarized in 5 traits: excitement, fear of missing out, overconfidence, herd mentality, and vulnerability to losses. These traits make them highly reactive to monetary policy shifts, often amplifying volatility far beyond what fundamentals alone would justify. For sharks, retail investors are both counterparties and catalysts, providing the liquidity needed to execute sophisticated strategies. For the Fed, they are an unpredictable variable in the transmission of policy. For the market as a whole, they are the crowd that turns a policy adjustment into a dramatic financial spectacle. Proposed trading strategies. After the Fed's September 2025 rate cut. When the Federal Reserve cut rates on September 16th and 17th, 2025, it created a structural shift in the market's risk-reward dynamics. For professional traders and disciplined investors, this was not simply news. It was a framework for positioning. A rate cut changes liquidity, alters asset correlations, and redefines capital flows. The following proposed strategies are designed to translate macro insights into practical execution, balancing both opportunity and risk. 1. Equities. Tactical participation. With defensive hedging. A Fed cut often sparks an immediate rally in equities, particularly in growth-sensitive sectors such as technology and consumer discretionary. However, history shows that the first post-cut surge can be unstable if growth data continues to weaken. Strategy. Short-term 1 to 2 weeks. Participate in the rally using liquid instruments such as index futures or ETFs, but avoid overexposure. The objective is to ride momentum rather than chase long-term conviction. Medium term, 1 to 3 months, rotate into defensive sectors, utilities, healthcare, and consumer staples. These segments benefit from declining yields but are more resilient if growth continues to slow. Hedging. Buy put options on the S&P 500 or NASDAQ to protect against sharp reversals triggered by weak macro data. This combination allows traders to capture the initial upside while maintaining downside protection, a necessity in volatile environments. 2. Bonds. The core opportunity. Fixed income is the primary battlefield where rate cuts show their deepest impact. With the Fed signaling easier policy, yields on longer-dated treasuries are likely to compress further. Strategy: duration play. Go long on 10-year or 30-year treasuries to capture the decline in yields. ETFs such as TLT or futures contracts provide liquid vehicles. Yield curve trades. If Powell suggests more cuts ahead, a steepener trade. Long-term bonds, short-term bonds may benefit as short rates fall faster than long rates. Conversely, if the Fed remains cautious, flatteners may be appropriate. Corporate bonds. Consider investment-grade corporate debt as spreads may compress in a lower rate environment. High-yield bonds can also rally, but exposure must be sized carefully due to credit risk in a slowing economy. For sophisticated players, this is the highest conviction trade because it directly aligns with the Fed's policy trajectory. 3. Currencies, dollar weakness, and carry opportunities. A Fed cut typically weakens the US dollar, particularly against currencies whose central banks remain neutral or hawkish. This opens opportunities in FX markets. Strategy: EUR USD and GBP USD longs both benefit from dollar weakness, though Europe's sluggish growth caps upside. JPY carry trades. The Bank of Japan remains ultra-dovish, making the yen less attractive. Funding trades in JPY to go long on higher-yielding currencies or assets can be profitable. Emerging markets. Selective exposure to currencies with strong fundamentals, such as the Mexican peso or Brazilian real, may yield attractive returns as capital flows into higher-yielding markets. Traders must manage volatility carefully, as geopolitical shocks can quickly reverse currency moves. 4. Commodities. Gold as the strategic hedge yields. Lower real yields after a Fed cut are supportive of gold and, to some extent, other commodities. Strategy: gold accumulation. Build medium-term long positions in gold through futures, ETFs, or physical holdings. This is both a hedge against financial instability and a play on lower real rates. Energy. Oil may benefit in the short term from weaker dollar dynamics, but demand risks tied to slower global growth require disciplined position sizing. Industrial metals. Copper and other growth-linked commodities may face headwinds if the Fed cuts signals deeper economic slowdown. Maintain selective exposure only. Gold remains the cleanest macro hedge, and institutions often accumulate quietly after the initial rate cut announcement. Crypto, a tactical satellite position. While not a core institutional asset, crypto markets are increasingly sensitive to global liquidity conditions. Strategy: Bitcoin positioning. Allocate a small portion of capital, no more than 5% of total portfolio, to Bitcoin as a liquidity proxy. Lower rates typically fuel speculative appetite. Ethereum and majors. Secondary positions may capture additional upside, but risk management is critical given volatility. Derivatives for control. Use options to define risk and avoid being exposed to parabolic swings. Crypto should not be treated as a core hedge, but rather as a tactical beneficiary of easier monetary conditions. 6. Multi-asset allocation. Balancing offense and defense. The best strategy after a Fed pivot is not about chasing one asset, but about structuring a diversified allocation. Suggested framework: 40% bonds, long-duration treasuries, and selective corporate bonds. 30% equities. Focus on defensive sectors with tactical exposure to growth-sensitive names. 15% commodities, core allocation in gold with tactical oil exposure. 5% crypto, a satellite allocation to benefit from speculative liquidity. 10% cash, dry powder to deploy during volatility. This balanced approach captures the upside from easier policy while maintaining resilience if the economy deteriorates further. 7. Risk management principles. Regardless of asset class, the essence of trading after a Fed cut lies in discipline. Position sizing. Never risk more than 2% of capital per trade. Stop-loss discipline. Assume volatility will spike and design exits accordingly. Horizon clarity. Distinguish between short-term tactical trades and medium-term investments to avoid emotional decision-making. Liquidity preference. Stick to highly liquid instruments. Avoid thinly traded assets during uncertain conditions. The sharks exploit retail traders' lack of discipline. To avoid being prey, smaller players must adopt institutional-style risk management. Conclusion. The Fed's rate cut in September 2025 is not a one-time event. It is the opening of a new policy phase. For traders, the correct response is not blind optimism, but structured opportunism. Bonds offer the highest conviction setup. Equities provide tactical momentum. Currencies and commodities deliver diversification, and crypto acts as a liquidity-driven satellite. With disciplined execution and risk control, these strategies allow traders to transform a macro shift into sustainable profits rather than emotional speculation. Hidden risks and contrarian scenarios. After the Fed's September 2025 rate cut, every rate cut by the Federal Reserve sparks waves of optimism, with traders and investors rushing to reposition. Yet, beneath this apparent opportunity lies a series of hidden risks that can derail even the most carefully designed strategies. In financial markets, the majority often leans in one direction, but history repeatedly shows that the most dangerous losses come not from what is visible, but from what is underestimated or ignored. To navigate the aftermath of the September 16th and 17th, 2025 decision, traders must recognize the contrarian scenarios that could unfold. 1. The risk of misinterpreting the Fed's intentions. Markets often assume that a rate cut equals the beginning of a long easing cycle. Retail investors, in particular, anchor their expectations to past episodes such as 2009 or 2020, when aggressive cuts ignited bull markets. But what if the September cut was merely a one-time insurance move rather than the start of a full pivot? Contrarian scenario. Powell frames the cut as a preemptive adjustment to protect against downside risks, but not a commitment to continuous easing. If inflation data stabilizes or rebounds, the Fed could pause further cuts, leaving markets overextended. Equity investors expecting a flood of liquidity may find themselves holding overpriced assets in a stagnant economy. 2. Inflation's possible resurgence. The Fed's decision to cut was largely justified by cooling inflation. However, supply-side risks remain. Energy shocks, geopolitical instability, and supply chain disruptions could reawaken price pressures. Contrarian scenario. Oil prices spike due to geopolitical conflict, pushing headline inflation back above target. The Fed is then forced to reverse course, tightening again despite fragile growth. This sudden policy whiplash would devastate both equity valuations and bond positions, punishing those who assumed that falling rates were a one-way bet. 3. The hard landing trap. The rate cut itself may be interpreted as a signal of weakness rather than strength. If the Fed is acting because it sees deeper recessionary risks, then the market's initial optimism could flip into fear. Contrarian scenario. Economic data in the fourth quarter reveals sharper contraction in consumer spending and corporate investment. The labor market weakens more aggressively than expected, pushing unemployment higher. In this environment, equities collapse despite lower rates, as investors realize the Fed is cutting not to boost growth, but to cushion an accelerating downturn. Bonds may rally initially, but eventually face credit stress as corporate defaults rise. 4. Dollar dynamics and global shocks. A weaker dollar is often viewed as a natural consequence of Fed easing. Yet, global capital flows are rarely linear. Emerging markets may appear attractive at first, but structural vulnerabilities remain. Contrarian scenario. The rate cut sparks an initial dollar sell-off, but global investors remain unconvinced of stability in Europe or China. Safe haven demand then flows back into U.S. assets, reversing the dollar's decline. Traders betting heavily on dollar weakness find themselves caught in a violent short squeeze, while emerging market currencies collapse under renewed pressure. Asset bubbles and fragile sentiment. Retail investors and momentum-driven funds may inflate asset prices far beyond fundamentals. This creates fragile conditions where even minor negative news triggers outsized reactions. Contrarian scenario. The S&P 500 surges in the weeks after the cut, but valuations stretch to unsustainable levels. A disappointing earnings season or a hawkish Fed speech sparks a sudden 20% correction. Retail traders who piled in during euphoria face devastating losses, and liquidity evaporates just when they need it most. 6. Liquidity risk and shadow markets. Lower rates may encourage leverage, not just in equities and bonds, but also in shadow banking systems and private markets. These risks often remain hidden until stress appears. Contrarian scenario. Hedge funds and private equity firms expand aggressively on cheap credit, but a shock in one corner of the market, such as commercial real estate defaults, spills over into broader financial conditions. Liquidity dries up, and margin calls trigger forced selling across asset classes. The very rate cut intended to ease conditions ironically becomes the seed of instability. Geopolitical and black swan variables. Markets in 2025 are not insulated from geopolitical shocks. The Fed cannot control external risks such as conflicts, trade wars, or cyber disruptions. Contrarian scenario. A sudden escalation in geopolitical tension triggers a spike in oil, a surge in defense spending, and widespread risk aversion. Equity markets fall, gold rallies sharply, and the Fed's cut becomes irrelevant in the face of global instability. Those positioned only for monetary-driven rallies are caught off guard. 8. The psychological trap for traders. Perhaps the most insidious risk is psychological. After a Fed cut, traders often become biased toward bullishness, ignoring signals that contradict their narrative. Contrarian scenario. Traders remain long equities and short the dollar, even as bond markets and credit spreads signal worsening conditions. Confirmation bias blinds them to changing data. By the time they recognize reality, sharks have already reversed positions, and smaller traders suffer steep losses from being emotionally anchored to the rate cut equals bull market story. Conclusion. Preparing for the unexpected. The September 2025 rate cut is a double-edged sword. On one side, it creates opportunities through lower yields, a weaker dollar, and risk-on sentiment. On the other, it embeds hidden dangers: inflation resurgence, economic slowdown, asset bubbles, liquidity shocks, and geopolitical instability. For disciplined traders, the lesson is clear. Every strategy must include contrarian scenarios as part of risk management. Stop-loss orders, diversification, and clear horizon planning are not luxuries but necessities. The sharks thrive because they prepare for multiple outcomes, not just the consensus. Retail traders fail because they assume the future will mirror the past. In finance, opportunity and risk are inseparable. After the Fed's September decision, the winners will not be those who blindly chase optimism, but those who anticipate the unexpected, adapt with discipline, and navigate uncertainty with the mindset of a strategist rather than a speculator. The Federal Reserve's decision on September 16th and 17th of 2025 to cut interest rates became the center of attention across global markets. Behind what might seem like a simple policy move lies a complex web of signals, both encouraging and concerning. As an analyst, I can present views, evaluations, and potential scenarios, but I must make it clear from the outset that everything here reflects only my personal perspective. It is not financial advice, nor is it an invitation to invest. Every financial decision carries responsibility, and each individual must take full ownership of their choices and risks. Whenever the Fed lowers rates, markets immediately understand that credit becomes cheaper, borrowing costs decline, and multiple asset classes may benefit in the short term. Yet the essence of such a move goes beyond fueling growth. It also reflects that the economy carries weaknesses significant enough to force policymakers into action. In other words, a rate cut is both a stimulant and a warning. Initial waves of optimism may lift equities, gold, or even digital assets, but the deeper question remains: why was the Fed compelled to adjust? And is this a temporary measure or a signal of a broader slowdown? In moments when markets are filled with euphoria and loud calls about golden opportunities, I believe composure is more important than ever. Large price swings always create openings for those with patience, but they also fuel illusions for the restless majority. Retail investors often fall prey to emotional traps, chasing rallies when prices are already inflated, or panic selling into volatility. This lack of discipline turns them into liquidity for the sharks who know how to manipulate the crowd. In contrast, those who resist the herd and patiently observe institutional behavior stand a better chance of long-term survival. Personally, I believe that instead of asking, "Is this my chance to get rich quickly?" investors should ask themselves, what level of risk am I truly comfortable with? What is my real objective? Am I acting based on analysis or simply out of fear of missing out? The honesty in answering these questions is what protects you in a market designed to exploit human weakness. Profits can come and go with every cycle, but survival is what ensures you remain in the game. Markets never run out of opportunities. Yet those opportunities only matter if you have a system to capture them, a framework that guides you on when to act, when to wait, and above all, how to enforce discipline regardless of noise. The Fed's September decision is only one in a long sequence of turning points in financial history. After it, new shocks will come, new cycles will unfold, and new stories will dominate. Those who blindly follow the noise will always pay the price. Those who build their own process will endure. Let me emphasize again. Everything I share here is my personal view based on analysis and observation. It is not a recommendation to buy or sell, and it is not a call to participate in any trade. You alone bear the responsibility for your choices, and only you control the fate of your capital. If you are serious about trading, invest first in your mindset. Strategies, indicators, and tools are useful, but they are surface-level instruments. The real foundation is your psychological framework, your ability to stay disciplined under pressure, to remain calm when the crowd panics, and to wait patiently when the market offers no clear signal. These qualities cannot be replaced by any software or indicator. That is why I invite you to join Trading Mindset Lab. This is not a place for quick buy and sell signals or promises of profit. It is a space to train your discipline, refine your risk management, and strengthen your mental resilience. These are the traits that build lasting success rather than fleeting luck. The financial world never stops moving, and the Fed's September 2025 rate cut is just one milestone in that ongoing flow. Sharks will continue to act in their own way, sometimes quietly, sometimes aggressively, but always with precision. Retail investors will continue to face the same choice: chase the crowd and pay the cost, or build a system and mindset to endure. My personal conviction has always been this: think like a risk manager, not just a profit chaser. Profits can vanish overnight, but survival and risk control determine who is still here after decades. If these reflections resonate with you, I encourage you to subscribe to Trading Mindset Lab. There, we go beyond charts and headlines to uncover the real essence of trading, where victory comes not from short-lived luck, but from preparation, discipline, and a sustainable mindset, the kind that even sharks must respect.